What's up, Outliers? Happy Friday. Today, we are getting back into the Outlier Options Trading Foundations series. Every once in a while, I kick off either like an options 101 thing or something that's designed in effect to approach newer traders. The Friday stream for a while just was perpetual versions of that, but not necessarily with a formal cadence. And I sat down the last couple days thinking what I wanted to do to establish a formal cadence. And we now have our next 5 episodes. Why 5 episodes? Primarily just because I want to get us to the end of the year. And believe it or not, we're actually running out of weekends. There's a little more than 5, but I'm also planning in a little bit of buffer time for Q&A and stuff like that. Then at the beginning of next year, I have another basics series, an actual 101 series. So for the series that I've built for us here, I'll give you a list of the episodes here so that you know exactly what to expect, which is this. My goal is to approach this under the context of folks that have a rudimentary understanding of options. My avatar in mind as I was building this is the person listening would be somebody that understands the basics, like what a call is, what a put is, what the stock market does, how exchanges operate, at least at a high level, not necessarily nuanced, and things of that nature. Now, what I'm doing is really focusing on a very, very specific part of the trader's journey, which is the aspect of building trades and the management of those trades in the context of a broader portfolio. When we start this session, there are a couple things that are being taken for granted, and some of them, really one of them, is probably the biggest thing that should not be taken for granted, which is why I want to specifically identify what is being taken for granted so that you understand where we're coming in at this problem set from. Now, here is one of our standardized strategy processes that I've alluded to before. However, this is more what we are going to be reviewing today, which the session today is designed for somebody that has developed some sort of idea and now wants to take that idea and turn it into a trade. Before this, there's this. This, as most of you have seen before, is the Outlier strategy process. It's a framework for building strategies. When we're talking about having a market idea that we're going to turn into a trade, it takes for granted in this context that you have a strategy for it. If you do not have a strategy for it, then there's really no need to go further. Focus on this. With that, I'm going to review this very quickly, just so everybody's on the same page. And then I want to work through a couple examples with you guys on the stream. And then towards the end, I will have a couple homework items for those interested in just seeing how much they can learn during this. I obviously couldn't possibly care less if you do the homework or not. I think it would be good if you did, but makes no difference to me. So, as we know in trading, there's especially derivatives, there's a lot of stuff that has to happen, and we need to have a fundamental understanding of options, how they behave, yada, yada, yada. At some point, it does come time to actually do things. And the things that we do as options traders is find trades. Now, one admin note to keep in mind, I am really specific about what kind of trader I consider myself. And I actually don't consider myself a quote unquote options trader. I consider myself just a trader. And the reason for that, as always, for those familiar with why I make this distinction, is because Options traders are like very narrow. It means that you only trade one asset, options, which isn't always the correct asset to speculate on an idea, which we'll talk a little bit about that. To get into a quick overview of what the outlier strategy process looks like, and I have a video that goes through this on the channel. You guys can go through in detail at your leisure. But at a high level, the entire purpose of the outlier strategy process is to completely reconfigure your brain, the way that you think as a trader. Because the way most traders start this game, as you know from me pontificating about this ad nauseum, is completely backwards. And I will illustrate the point for you quickly, and then we will move on. The majority of traders, specifically options traders, they do something like this. They find the stock market. They then find options. They learn a little about options. They learn a little bit about structures. And then they trade. Correct me if I'm wrong. Genuinely. I don't mean that rhetorically. Like, if you think I'm missing stuff from this, I genuinely would like to know. But in my estimation, this is the broad thing that happens. Now, somewhere in here will be stuff like analysis. So this will be like technical analysis, fundamental analysis, somewhere in that span, but not hyper relevant here. The issue with this is, if we think about what the concept of edge is, where in this process would we have identified any type of edge? It's not understanding stocks. It's not understanding options just at a high level. It's not understanding the Greeks. It's not understanding implied volatility. It's not knowing different configurations of options. It's not knowing Bollinger Bands. It's not knowing how to read a balance sheet. Clearly, it's not in actually then clicking the button. So where's the edge? Where do we think the edge comes from here? Because it's literally not in here. This is the broken way that just about all of us start trading options, myself included. Again, whenever we have these conversations, I want it to be abundantly clear. I am not better than any of this. Most of the stuff that I talk about is literally based on the shit that I've fucked up. So just keep that in mind. It's entirely possible, if you make these kinds of mistakes, to absolutely overcome them for sure. But first part is identifying the mistake. And this is the mistake. This is how most people start. In reality, when we try and build something that actually makes money, rather than us following this process of understanding stocks, options, structures to trade, we need to have something that we're trying to trade. I would argue that this profit mechanism concept fits somewhere in here between structure and trade, analysis, somewhere in there. It's definitely not before this, believe it or not. And it's because you have to have a rudimentary understanding of things in order to even conceptualize different ways to make money. This, absolutely. Where you decide in your process to put this in, it literally has to be there. There's no negotiation. Whether you choose to call it something other than a profit mechanism, that's cool. You can call it a market effect. That's completely fine. It's essentially synonymous in my brain. The difference, as I mentioned, in my brain between a market effect and a profit mechanism is a market effect isn't necessarily something that you can monetize. It could just be an anomaly. It could just be something you saw there. A great example, actually, is in the Discord. A member noted a interesting behavioral pattern they identified in GameStop. We're at 0100 their time. I don't know what their time zone was, But it was obviously when the market was closed at 0-100 over that 1 minute candle, they saw a volume spike on that candle for like 5 days consecutively. That is an effect of some sort. What's causing it, what it means, that's always open to discussion. But regardless of that market effect, there's no way for them to trade that. So it doesn't actually matter other than good knowledge, just being aware that it exists. Now, when we think about the topic of the video today, which is turning a market view into an actual position, it takes for granted that this step is done. That means that you have an understanding of at least some profit mechanisms, and you have a fundamental understanding of different ways that you might be able to capture them. That leads us to where we are now, which is we have a market view of some sort. Let's take a look now at the outlier trade process. This is one step in from the outlier strategy process. Whenever I'm beginning the cycle of placing a trade, it generally follows this overarching process. If I have something that I saw in the market that's interesting to me, I don't immediately run anywhere with it. I mentally note it and I actually start here every single time without fail, every single time. What this step is understanding what my portfolio currently is, and then if it needs anything, or if I'm free to speculate. This first step includes checking a couple really important diagnostics. Some of the stuff that's going to go into assessing portfolio fit / need is we need to understand overarching what's our idea. So what's our market hypothesis? Why does this matter? Well, it's highly informative. If I have a portfolio that's mostly long beta weighted deltas, and I see that NVIDIA is skyrocketing, do I want to start piling into NVIDIA if the rest of my portfolio is already long beta weighted deltas? Let's say it leans tech heavy, and my overall market hypothesis is I think things are starting to roll over, meaning we might be consolidating or we might be starting a downtrend. Of course not. It makes no sense. The point here is that the first stop before placing a trade every single time, makes it easy, is to take a look at the portfolio. And it's clarifying what the portfolio currently needs. So if I adjust this to need and fit, that's essentially the concept captured there. So let's continue this scenario. Let's say that it's Tuesday. I open up my platform. I see the portfolio. I look through the portfolio and I see that it has no specific needs. Okay, great. Then the next thing I need to check is, do I have room to add more risk? That means, how utilized am I? How much risk do I want to have out? And can I use more? Do I need to use more? And let's say that the answer to that question is also yes. Now is when we begin looking. So this is scanning. This is where we pick up the session for the day. This specific pickup point is that we've gone through the outlier strategy process. We have some ideas of market effects that we're trying to capture, and we have some strategies associated with those. We look at the portfolio, we see that the portfolio doesn't really need much, but we can add more risk. Now we conduct scanning, and that depends on whatever your process is. Whether you're using alerts, whether you're manually running scans, whether you're poring over charts, whatever works for you. At that point, you might see something. Now is when we take whatever we see and we turn it into something. And there's a bunch of different ways we can go through this exercise together. But I want to start with an overview of what needs to happen during this stage. One thing to keep in mind is, as I'm talking about this stuff, it might seem like there is a lot of stuff, a lot of moving parts. And I'm not going to sugarcoat it. In reality, there are. But just like if you think about what an athlete is doing when they're playing football or basketball, an athlete is typically doing a lot of stuff at once. They're typically running or moving in some capacity, communicating with their teammates, monitoring what the other team is doing, and making all sorts of calculations, right? Like there's objectively a lot of moving parts going on in that arena as well. Same thing when you're driving a car. The point I'm making is when we slow down and we break out each individual component, it can seem like a shit ton. And again, it is, but it's no more complex than these other things that you've seen and done in your life. I make that point just to make sure that as you see this, it doesn't start becoming overwhelming. It shouldn't be. This is well within everybody's wheelhouse to do this style of analysis. Now, the ability to create edge and capture it over time, well, that's where the wheat is separated from the chaff. That's harder for people to do sustainably, but that's a whole other bag. So we look through the market and we now see something that gives us an idea. We have some sort of trade that we want to take. Let's use, I'm literally going to pick something completely random. Well, it's not completely random, but not really based on anything hyper relative to this. But let's take a look at RGTI. Let's say in RGTI, you just heard that the White House or the current administration is talking about taking larger stakes in some of these quantum computing names. Actually, a handful were listed, like RGTI, IonQ, and then I think maybe one or two others. That's the basis for the idea. So what's happening here? We caught a piece of news, also referred to as a catalyst. That catalyst is expected to cause a change. We are looking to monetize the change. In this context, the catalyst, the concept of the catalyst is not what makes money. What I mean by that, it's not Trump saying, I want to take a stake in these names. Now, that could move the market for sure, but that's not ultimately what the profit mechanism is. The profit mechanism in this scenario would be demand increasing, driven by federal purchasing stock. This is a lot of words. What does this boil down to? Price up from greater demand. That's it. That's the idea here. If this thing happens, and if the federal government starts to purchase ownership of a company like RGTI, that will shift the very standard supply and demand balance that exists today, and it will cause some sort of knock-on effect. In this kind of scenario, the question then becomes, how can I get very specific about this profit mechanism? What do I think can conceivably happen end to end with this idea? We have the first part of the idea already, which is like an announcement. This is initial expectation setting and interest setting. This announcement in and of itself could be a profit mechanism. It could lead to a change in price. That's in anticipation of a subsequent change in price, but it doesn't inherently mean that it's going to happen. So there's the first potential idea. The next potential idea is when the announcement is formalized. This is when the government says, we are going to do this. That offers another profit mechanism based on an announcement, based on news. So these two so far are based purely on news, information being integrated into price, causing discounting and supply-demand shifts. The next phase of this is when they're actually purchasing. When they begin, if they begin purchasing, that will be another profit mechanism. How might that unfold? It might unfold where we see volume starting to climb, and we can quantify that. So far, there are 3 ideas associated with this. I'm going to tick this first one off because it already came and went, and we're going to focus on these 2. For these 2, the next thing I need to do is start figuring out what signals are relative to this. If I think about what signals become important to me in understanding if Trump is going to make a formal statement that they are going to take a stake in X stock, because that's another really important thing related to this specific market idea. Is this isn't saying, oh, RGTI is the name. It's just saying RGTI is one of the names. So what does that mean? Well, the main signal, obviously, is any sort of formal announcement. That's one. The second thing is potential front running of the announcement. This can come across in different ways, typically in the options markets is where I would expect to see it. For the purchasing side of things, this is when you're going to see changes in price and volume in some way. The next thing I need to do in this case, because I'm not starting the scenario with a specific stock in mind, I need to identify what the tradable universe is. And in this case, it's quantum computing stocks. Fortunately enough, there's not a lot of them. So even if I wanted to monitor every single one of them, I could. It's not that difficult. But we already can narrow that down further by speculating which of these stocks might be more likely targeted. And again, that's probably going to be stuff like RGTI, IonQ, and a few others. So now we have a very loose outline of this specific idea. We have it broken down into different phases where different profit mechanisms are likely to come into play. The announcement, I would expect that to be relatively short-term price movement, reaction to the news. When it gets formalized, this now would be more extended price action, continuation of the news, and discounting. And then the purchasing is the mechanical component of supply and demand now moving because things are actually being scooped up. So there's 3 different things that we outlined. As we outline these, typically, I would want to get into more detail on these individual profit mechanisms. And again, taking for granted that somebody has done some level of homework and at least has some level of understanding of maybe a momentum-based strategy. What I can do is take that momentum playbook and I can adapt it to this specific scenario. Is it the exact same? No. Does it need to be? No. It just needs to be good enough. When I start double clicking into these profit mechanisms and their features and what they look like, it's important for me to be specific. Because, for example, I don't know what methodology they're going to apply if they choose to start purchasing the stock. Why does that matter? Because if they choose to buy a bunch of it super fast, that's going to cause price to go up really aggressively. Whereas instead, if they say over the next 2 quarters or the next 4 quarters, we're going to accumulate a total position of blank dollars, then that price movement effectively could get lost in the wash. It's a very different thing. The way that it goes matters a lot in the way that I subsequently choose to trade it. Let's now zoom in on this one specifically, where it gets formalized. What I can do is begin outlining what features I think that profit mechanism is going to have. In this case, I think it would be news-driven. I think there would be a short-term response. And then I think there would be a drift component where over the next some duration, that information is going to get baked in, more or less. Now, the cool part is there's ways to trade these together or disparately, again, depending on how things fit into your portfolio. But at this stage is where I would actually start attaching strategies to these. For example, for the news-driven stage, the more direct catalyst, I'm going to favor shorter-term strategies. I'm going to favor stuff that's long gamma or short vol. For the drift element, that's inherently longer term. I'm going to favor things also that are long deltas, long gamma. How do I know that? How am I going to rattle that off? It's because of completing the outlier strategy process. It's not this big, massive question that sits in my brain of how can I possibly trade these? I already know how I could possibly trade this thing that hasn't even happened and might not happen. But now I have some sort of loose playbook in mind. From here, it's when we start getting into more detail of the individual opportunity. BPF says, when do fundamentals start to matter? RGTI has a market cap of 12 billion and trailing 12-month revenue of 7 million, giving a PS ratio of 1100. It doesn't have PE because it makes zero money. Fundamentals matter when fundamentals are an important part of your trading style. This is one of the things that takes a little time to dial in, and this is why I think it's really, really worth the time of traders to test and create a signal library for themselves. So in my trade plan, I have a list of all different kinds of signals, literally hundreds of them. And I create an outline of what it is, what it's meant to do. And then for those that I have actual data on, meaning stuff that I've either back tested, live tested, or are currently testing, I track those details. Because of that, you'll find certain signals matter more than others. Certain signals also become made more relevant to both the profit mechanism and the strategy. So, for example, in this case, I couldn't possibly care less about fundamentals at all. It means nothing to me. Don't care at all. And it's because for this specific element of formalizing the profit mechanism or formalizing the announcement, I already know that's going to positively affect price, and it's going to discount up, meaning people are going to front run that expectation of a move. Now, when they front run that move, I don't really care if it has any sort of specific ratio. I'm simply trading that price activity. If instead I was applying some sort of Warren Buffett-esque style approach, where I'm looking to gain entry into things that are kind of beaten down and then I'm looking to hold them long term, then I definitely care about fundamentals. Same thing if I'm trading any sort of more swing style plays. So for example, for step number 3, if they start purchasing, then and depending on the way that they purchase, I actually would care a lot about fundamentals. I wouldn't care about a PS or a PE ratio because those are historically proven to be effectively entirely irrelevant. But I would absolutely care about other ratios that I find to be more statistically significant. The TLDR is fundamentals or any other signal, not relegated just to fundamentals, but any signal becomes relevant when it makes sense for the profit mechanism and for the strategy. A great way to wrap our minds around that is if I'm trading 0 DTE SPX options, do I really care what percentage of S&P stocks are above their 50-day moving average? No, doesn't matter to me. So the way that we get to that is we start by looking at the profit mechanism and we think of what signals are most relevant to this. And if you ask yourself that question and you're like, I have no idea, which is completely fair, now we know we need to test. Because if you have no idea, then that means that we have a gap that we have to fill. It's not going to, just magically appear to us. So, but that's the question you would want to ask yourself. So it's a great question. And signals can get really, really, really dangerous because they're really alluring. Sometimes people will pretend as if like this signal catches all this stuff, and they just really don't work like that. The most important thing I could say when it comes to testing different signals is finding ways to actually test them and not only see how they behave so that you understand them, but also seeing how you implement them. Because there are plenty of instances where a signal might be objectively completely fine, doesn't do anything wrong, but for some reason, certain traders just can't wrap their minds around it. That's not a good sign, but that does happen. Let me know if you have any follow-ups on that BPF. Lauren says, could you create a synthetic long call position to catch longer term drift? Definitely. That would be a completely viable way to approach the longer term drift in something like this. That would also be a pretty smart way to try to neutralize some of the excess volatility that names like this typically have that can make it more difficult for getting into like a position that makes sense. Because after we finish this scoping exercise, the last step to actually turn it into a trade is to actually turn it into a trade. So this is where we figure out which one of these is most relevant at what point. And then we create some sort of triggers that lead to our reaction. So for example, formalizing whenever the federal government comes out with a statement and says, we are going to do blank, that's now formalized. I'm going to set up different kind of scrapers to help me identify that news for sure, so that I can get it as fast as I can. I know I'm never going to get it super fast, which is why there's another part to this, which is watching the options market for hints that that news might be coming by people that know more than I do that are positioning for it. That's where I apply something like unusual options activity to try to dial that in a little bit more. From there, it's applying this specific strategy, and then it's refining the actual entry point. So let's say, for example, the federal government comes out, they say, we are now going to do this thing. The first thing I'm going to do is see how price is behaving. And then I'm going to follow this playbook. What that looks like for a shorter term long gamble play is I have only a couple strategies that I do that with. So I'm literally just going to go to those strategies. When I pull up one of those strategies, I have to apply my standard analysis before I'm entering the position, which is here. Going through some sort of trade checklist before I enter to validate everything that I think I'm about to enter into. So let's say, for example, in this scenario, I opted to go shorter term, further out of the money calls. Let's say I go out 28 days. What I'm going to do at this point is use the rest of my ensemble, understanding of options, understanding of the profit mechanism as best I got, understanding the strategy. That's how I determine what delta do I want? What gamma do I want? What theta am I okay with? All of that comes from the homework that's done in the outlier strategy process. So this is the part that trips a lot of people up because they're looking to just place trades, and often highly prematurely. It's super, super, super important to do this work, because without doing this work, a question like this becomes very difficult for a trader to answer for themselves. So to summarize that, and then happy to open up to questions and have an open conversation with you guys. When we're taking our idea, something that we saw in the market, and we're looking to turn it into a trade, we always are going to start by having a defined playbook of stuff already. So this is having different kinds of strategies that you know fit specific kinds of conditions. Again, for example, that's how I know on the day that the news breaks, I don't want to necessarily go short puts on that day. Why? Because I'm going to miss most of the move. Would it be profitable? Sure. But is that optimal for that specific kind of expectation? No. I have defined profit. I don't want that there. And when I'm choosing to go shorter term in buying options, what does that tell me? That I'm not expecting to hold this thing that long. Again, all of those small details are defined here. And then it's just carrying that into this process where we make sure the portfolio doesn't have anything we need to focus on to start. Then we come across this opportunity. And then we go through that process that I just laid out for you, where I outline the profit mechanisms for the different cycles of that example. I think about what signals are relevant to help me figure out if it's happening, and then to time my entry and then inform management. All of that's done with different signals like we were talking about. And then it's going through and actually building the trade, just putting it all together at that point. This is where all the ingredients get mixed. This is where we're looking at the recipes and getting the ingredients, prepping the ingredients, cooking, all that stuff is done up here. And then this is when we put it all together. All right. What questions do you have? What elements of that would you like to dive into? What stuff wasn't clear? It's all open for conversation. Again, this is completely beginner friendly. So if you have something that we reviewed there and you're like, I'm not fully sure of what that was or how to implement that, tell me, and happy to discuss. Kirk says, so you essentially have these profit mechanism strategies as second nature and can put on proper position with optimized Greeks within the trading day, or are these thought out for days? It does depend on the catalyst, because some catalysts and some market effects can be like really tricky. So figuring out what's optimal can definitely get more challenging. In something like this, it's something I've seen literally thousands of times in different flavors. When I think about the broader order of what this kind of trade idea falls into, there's really two buckets. There's a catalyst component, which again, I've seen tons of, and then it's effectively institutional sponsorship, which is a whole other thing that I have an entire series of playbooks associated with. And in this case, it's not technically an institution, like market institution, but it's effectively an institution. The way that they'll enter the trade and the way that they'll build the position, it's going to look just like an institution, more or less. That itself is pretty much where, if we think at a high level, most things fall into only a few categories. And then if you go one level below that, we have many more categories, but still not a ton. Most stuff is not going to fall into like a gajillion different categories. The place where things get really, really nuanced is when you're down at the bottom of the tree, right? So if I think about top line profit mechanisms, what things can do in the stock market, price can go up, price can go down, volatility can go up, volatility can go down. Like that's effectively it. Now, you can include yields via like dividends, but that's also going to be partially captured in price, but we could call that its own thing as well. Like that's it. That's effectively what you got. And then within those, there's subsections that we start getting into more nuanced stuff like this. So a lot of this stuff will just be different versions of the same thing over and over again. This is, again, one of the cool things when you change your brain from thinking about like individual trades as like these hyper unique individual unicorns, and you just start understanding that they're all different kind of fucking versions of the same shit. And that helps a lot when you're kind of building a way that you want to attack these different things in a trade plan. For the more nuanced stuff, that can take some time. So, for example, when I was devising how I wanted to trade 0-day index vol, that was not something that happened super fast. That was something that I had an existing idea for, but it needed a lot of research to optimize that. Now, at this point, it's literally one of the easiest trades that I do. It's mindless, effectively, at least when I'm clicking the buttons. It just literally goes on like every single day. There are certain rules that I use for scaling up, scaling down, sometimes adding wings, sometimes not. And at this point, it's all built. So when I take that same idea that I built for index vol, and then I apply that to another index, that's also easy. It's effectively the same thing. Different index, some different calculations I have to do, but it's effectively the same thing. So again, what I'm showing you is that when you go through the investment process of like building a strategy or building a way to do things, it gives you a jump off point when you want to apply a similar thing in slightly different stuff. Helen says, where can we get the playbook? You have immediate access to the playbook via your brain. You got to make your own. There isn't one that I give out to people. Trading is an individual effort. So the way that you build a playbook, build a playbook. That's it. I am here to help. I do my best to share information, to share experience, but it is always up to the individual trader to do the stuff. So the way that you get a playbook is to do the stuff. Do the research that I'm explaining. Start here. Do this. If you approach trading lazily, it's not going to work, unfortunately. I'm in the process right now. I haven't shared it more broadly because it's still in the very early phases. Bay Area, go ahead. Tell me what your question is. I'll tell you my story in the meantime. What I did is I have one specific strategy that I would call it like medium complexity, medium difficulty. And I literally wrote out an entire process for it. Everything. And I found a friend that is willing to be part of the experiment with me. I know the strategy makes money. I know it for a fact because I use it. And I've long hypothesized that if I give somebody a strategy that I made that I know works, and I give them some detail, but not a ton, because this person also trusts me a lot. So I know for a fact if I told this person, just do this, they would do exactly that and just do it. So I had to game the game a little bit. And I effectively said, this is like pretty sure it's going to make money. So it's not with certainty. I had to throw some sort of decoy, but it's with near. My guess is when we get to the end of the 4-month experiment, I'm going to find that they've deviated. Even though they will have pretty solid factors. And if they're logging and tracking well, they'll actually see a lot of the stuff that they would need to see in order to maintain confidence. But I didn't tell them to log and track and do all that stuff. So my guess is that they will deviate. That's my guess. Andrew says, do you have any strategy for earnings? Yeah, for sure. Here. So for earnings themselves, there are like 3 broad profit mechanisms. There's the behavior of implied volatility coming into earnings. There's the behavior of volatility following earnings release. And then there is price direction following the release, a continuation drift. Those are the 3 ways that I trade earnings, and I trade all 3 of them. The way that I trade the first 2 are very different. There's not a lot of stuff that I'll trade the pre-drift and then the post-collapse, but definitely, yeah. Earnings is a really big part of what I do. For those that are in the Outlier Pro community, where like on Sunday we do a market prep together, a lot of them are probably tired of how much earnings stuff we look at, which I do feel a little bit bad for, but it's a big part of what I do. This is how I make the money that I do trading, because I have things that do different stuff. And the beautiful thing about trading earnings is that it truly is a non-correlated return to the rest of the stuff that I do. This is exactly how I hold a levered long beta position. And even when the market is down, I'm able to make money. It's because of this other shit that I do, which is a big part of it. And earnings is a big piece of that. So definitely trade earnings a lot. There's, again, like 3 main profit mechanisms that I target for earnings. And they're super robust. That's one of the cool things about earnings plays. They've been around for a long time and like really well studied. Bay Area says, when you're long leaps and you find there's a large government stake, How should one factor this into their thesis positioning? I would just think of it in terms of what impact you think that's going to have and how you feel about it. You can either integrate that into your existing trade idea, or you could easily integrate that into a standalone trade. Both of them are completely viable. Black Mama says, your thoughts about Zebra Call. I love taking risk, and zero structures are what I aim for. I literally have no fucking idea what a Zebra Call is. The different structure names out there are literally so ridiculous, it's not even funny. But my instinct here is I probably won't like it. And the reason why I don't think I'll like it is because I don't know what it is, which tells me that it's probably a suboptimal version to do anything. So my instinct is I won't like it. So let me see really quick. I'm going to look up like what the fuck a zebra is. I'm going to ask ChatGPT, what the fuck is a zebra call spread? I'm assuming it's a spread of some sort. Oh, man. It's literally a back ratio. Got it. So this is really just designed to be a synthetic stock position. I don't really care at all about this. The way that these are designed to work, any sort of back ratio is really designed to try and give you a little bit of extrinsic value. And again, it's essentially a suboptimal version to do pretty much anything else. So most of the time for these, at least I don't know if there's anything specific about a zebra, but just simple back ratios. It's a way to try to essentially have synthetic long, but some of the long call properties. Yeah. Black Mama says, for long-term holding, it's a cheaper, sophisticated leaps. It's kind of not, though, right? Like, again, that's the problem with stuff like this. The problem with stuff like this is that people try to get too cute with things, and then it literally just neuters the thing that they're actually trying to do. So, for example, if I wanted to trade leaps on something and I wanted some sort of long exposure or long-term exposure to something, there are a few ways that I can play that simply. But the issue with something like this is that it literally just starts pulling away some of the stuff that I want. However, this isn't that far off from a strategy that I use a lot, which is a ratio diagonal. The reason why I don't like this, but I like a ratio diagonal, is because I gain very, very little by selling the in the money call. I do not gain that much by selling that in the same expiration, specifically if I'm far out in time. At that point, I would much rather just run a synthetic long if I wanted to have extrinsic value flattened out. But there is literally no having your cake and eating it too. If you want to be long options, long gamma, long convexity, there is a payoff for that. This doesn't get rid of that. The reason why this starts to neuter it is because now you have a counter opposing part of the position in the same expiration. It's really going to dampen things. Let's say, for example, I go further out in time. We'll go 80 days, something like this. And we'll buy 2 here, sell 1 here. Get rid of this one. And then conversely, let's just say I buy 1 here. Go a little further. What are the deltas? Oh, I forgot. These are, my bad. I got to reset this because the deltas on this are so skewed out. I want to be at like a 50 delta because that puts these on for a little bit cheaper, which is better for them. So it's to help the base strategy here. So I can do that. I can do this. I can do this. Let's just take a look at a couple scenarios really fast. Right now, I'm going to start by analyzing the extremes. So if we get a 15% move up, I make 312. If 15% down, lose 244. In this scenario, 15% up, 284. In this scenario, 311. This is just using long calls that are out of the money. And then the final here, up 15%, make 432, down 15%, lose 654. So more risk on the downside. What's the trade-off here? The trade-off here is that as the thing starts to make moves more and more in your direction, which is the base for the position, you don't participate. I would much rather, again, just take the position as what it is and just take the risk. That's the whole point of my speculating. So the zero extrinsic back ratios, I think it's, again, when traders don't like what options are and they try to turn them into a different structure, but they don't realize the trade-offs that they're making as they do that. And it just leads to suboptimal outcomes, right? There's no reason why I would do this in something that I'm bullish in. But all that being said, and to be supremely clear, if you like them, use them. There's nothing wrong if you like something, just because it's not something that I would use or I don't necessarily find it optimal. If it's something that works for you in some way, I would always say just do whatever works for you. All right, let me get caught up. Splashy Sam, that's a hell of a fun name. Reminds me of like an Xbox name. Says, do you think systems can accurately capture gamma profile hedging? Have you chance used option depth? You mean, Splashy Sam, you mean different platforms that try to detect when there's gamma hedging and then to profit off of that? Or do you mean something else? BPF says, off topic, what's your degree in? Undergrad was criminal justice and statistics. I thought I was going to do the Marine Corps and then go into the FBI. And then my master's and MBA was statistics. So mostly stats. I'm getting caught up. Okay, so Splashy Sam says gamma profile visualized in updated volume profile. Oh, yeah, okay. So you're talking stuff like this. We would just call that GEX. Like this. We can visualize GEX a bunch of different ways, like this. For GEX itself, I mean, it's a thing, like you can see it, but in terms of actually like what this does for us, it's really not much. This is one of those things that I think has become more popular for traders because it's kind of cool. And it is cool. I like this stuff. I think it's interesting. But the total benefit derived from stuff like this is really, really low. And it has everything to do with the underlying assumptions that go into creating gamma exposure. It literally forgoes probably the most important part of dealer positioning. They completely miss this. So, and that's not like a knock against the platforms that do this. It's literally like they functionally can't get the information that they would need. So because of that, it's neat to look at, but it really doesn't translate to much. I monitor stuff like this more out of sheer curiosity from a research lens, but outside of that, I really have never found significant correlation between profitability and different GEX exposure, gamma levels, stuff like that. So yeah, if you have a specific question about like using it or a strategy that you're exploring with it, happy to talk about that and share some thoughts and, you know, discuss, maybe brainstorm a little bit. But yeah, I've looked at these quite a lot. I've used them quite a lot, and I've studied them way more than both of the prior, and I don't see anything super convincing about it. Splashy Sam says, can you suggest your favorite options books that have more applicable properties than theoretical? That's interesting. And I actually really, really like the fact that you're saying practical versus theoretical, because you're right. There are a lot of books. That's one of the downsides, I would actually say, with Ewan's books, who everybody knows I genuinely am a very, very big fan of. Funny enough, the book that I would recommend to you isn't released, which is so frustrating. I literally have emailed Ewan like 2 or 3 times asking him to release that book for you guys, because like that book's actually good and it is very practical. So unfortunately, the one Ewan book that I would recommend is very practical, is not released yet, but I'm doing my best to see if I can get him to release it. I think the book that I would recommend is Options as a Strategic Investment. It's the book that I recommend for pretty much every single options trader, and it's because it does have a lot of theory in it, but it also has a lot of practical application. It's kind of like a big textbook. That's where I would go. The thing to keep in mind, though, is I wouldn't run away. Okay, good. You're reading it. Great. I was going to say, a lot of people will look at the book and be like, damn, it's a big book, or like, I don't want to read all that. And it's like, the theory element is important to understand. It's like anything else, right? It's like if you go back to high school and you think about some of the stuff that you learn in your high school curriculum, a lot of times you're sitting there thinking like, what the fuck is this? Like, what am I looking at? And the irony there is, more often than not, it makes no sense at that point, but then as you build on it, it starts to make more sense. It's kind of like the same thing. So yeah, I would definitely say that. Helen says, going back to the playbook question, start by learning strategies suitable for bullish versus bearish, short-term versus long-term, and then see what signals works and go refine from there. It's a good question. I have a couple videos that I think will be useful to you. Specifically, one of them, obviously, as you might guess, is on the strategy process. The way that, and I have a couple other videos that talk about exactly how I would like think about starting to trade. There's 2 ways that I approach this with people. The first way is what I consider the more approachable way for most. And then there's the slightly more nuanced method. So the easier way, I think, is by starting with long beta. So this is buy and hold, or DCA, in index ETF. And then find ways to optimize this. Why is this? This is a really low risk way to get into trading. It's because buying and holding or dollar cost averaging into VOO or SPY is what most people would do anyways, no matter what. That then can be optimized slightly, because let's say, for example, we look at some charts in SPX, and we can see periods where SPX goes through these bigger drawdowns. If there was a way, a methodology for you to avoid these bigger drawdowns or limit your participation in these bigger drawdowns, then you can really amplify your returns without doing a whole lot. So that's an easy starting point. The next starting point beyond that I do think is probably worthwhile is to start with what's logical to you. So this is like what intuitively makes sense. So for example, the concept of trying to day trade never intuitively made sense to me. Like I understood the concepts, I knew what it was, but all of the research that I've done showed me that those really hyper short-term timeframes intraday are exceedingly hard to predict, time, trade at size reliably over time. So that led to me staying away from day trading. Does that mean that it doesn't work for some people? Of course not. Some people are completely competent day traders. I'm not one of them. So it's not something that I do. The way that I would test the rest of this stuff is actually just focusing on paper trading. But to be very, very specific for Helen, I wouldn't think about strategies in terms of bullish versus bearish or short-term versus long-term. I wouldn't think of it that way at all. I wouldn't approach the problem that way at all. I would approach the problem from profit mechanism. What is the specific market effect that I'm trying to make money from? And how does that behave? Because if you do that, it's immediately going to inform the rest of those things that you're saying, right? If the profit mechanism, for example, is post-earnings announcement drift to the upside, I already know I'm bullish. I already know what the duration is. It's typically persists over the following quarter. So those data points immediately inform what kind of position I might want to put on to capture that. A lot of traders make that mistake, and it's super common, where we focus on these smaller assets or subsets of options, but it has us looking again at the wrong place, optimizing for the wrong stuff. The way that I would start that process, as you're outlining, is here. So the way that I would think about these profit mechanisms, I would just think about stuff that I see in the market that I think I can make money from, whatever that is. So I just gave you one example, which is post-earnings announcement drift. We already talked about two other examples, all related to the same effect in earnings, which is pre-ER IV drift, post-ER IV contraction. There's three right there. So the first problem set is actually just sitting down and doing this homework. What are the very specific market effects that you can see, that you can quantify, that you then think you can capture? Then is when I would start worrying about what kind of options, trades, what structures, what durations make most sense. Because for example, again, going to post-earnings announcement drift to the upside, I immediately know trying to trade that, well, funny enough, terrible example, because you can trade the initial day of it and then not more. But in general, if I'm going to trade the full post-earnings announcement drift effect, I know that that's going to be a slightly longer term thing. That's going to take place over the next quarter. So that, again, gives me duration inputs from the profit mechanism. What doesn't work is if you optimize a specific strategy, a structure, a management plan, and then you just force fit that on a profit mechanism. It makes no fucking sense. And people do this all the time. This is when you'll come across people that say like, oh, I manage my short premium trades at 50% max credit. It makes no fucking sense. It's something, but it's not made specific to this, whatever the thing is that somebody is trading at all. So for example, if you apply that methodology in something like SPY, and your goal is just to maintain constant short vol via short puts upside exposure in SPY, you will find that just arbitrarily taking profit at 50% underperforms stuff like just maintaining a certain delta band. But it's because it's optimizing for the wrong thing. TLDR, I would focus on profit mechanisms first and then let that inform what the rest of the shit is that you want to look at. That's the order I would go for. Black Mama says, okay, suggest other ways to reduce debt of the debit of the leap with delta 90 to 100. That's impossible. No, that's literally completely inaccurate. It's not impossible. So I would always caution people that are learning something or getting more familiar with something or even experienced. The funny thing is I always give this caution to newer traders because experienced traders don't do that. But it's not impossible. It's actually entirely possible in a few different ways. But more importantly than all of that, the way that I would think about that is not so much like, is the goal to reduce the debt of leaps and keep your delta at 90 or 100? Or is the goal to make money, right? Like, what are we optimizing for? But just to satiate the example and to not say that it's wrong and leave you blue balled, I'll show you exactly how you do that. The way that, and I'll actually show you how you get rid of even more of the debit, because again, the issue with the back ratio is you still keep a healthy amount of that debit while you're still getting rid of the rest of the stuff. The way that you do that is you literally create a synthetic long. You can even get these for a small credit. So for example, what I'm going to do is trade something that has put skew, or most of these things will have put skew, where I'm going to go long a call and then I'm going to go short the corresponding put. This has a delta of 100 and it actually has no extrinsic value whatsoever. And I'm getting a small credit for it. This is called a synthetic long. Risk reversal is another way to frame stuff like this, but you absolutely can do that same exact thing, but even collect a credit for it versus having to lay out a debit. But more importantly, again, I would just caution against the argument, right? Because the argument that you posed is, can you reduce the debit of a leaps while keeping your delta? And it's like, is that the right question? Because I would argue it isn't. The right question in that scenario is, as usual, what is the profit mechanism? And then what's the best way to capture that profit mechanism? Because again, I cannot think of pretty much any scenario where I would say to myself, the back ratio is optimal to capture something. That's why it's literally why I didn't even know what a zebra was, because I'm not familiar. I don't really use that acronym, but back ratios themselves can be absolutely fine. But I would just make sure that we're addressing the top line problem first. It's a good question though. All right. I think I'm all caught up. BRB says, I found GEX to help as a check of net positioning. Lots of positive net gamma, generally well hedged, mean reverting. But that's the thing is like, it's not true. And that's the dangerous part about GEX and DEX. So BRB, what's happening there is you're seeing what you want to see. The thing that you're seeing is what you're told you're supposed to see. That's like a magician, right? A magician says, follow my hand, I'm going to do this thing, and then it's gone, right? Like that's exactly how a magician tricks people. That's exactly what's happening in your brain with this. You are told that this is supposed to show you areas of congestion, and then you are told that this is going to identify periods where if price gets near these levels, it's going to be either amplified or more mean reverting. However, there is a massive, massive problem with that entire assumption, and it's why this doesn't mean that much. Does anybody know what that is? I'm super curious. And while you're guessing, I'm going to grab a water and I'll be right back. All right. Who knows? There is a Splashy Sam says change happened only over the last week. That's not it. It's a good guess. BRB says, I'm assuming because you don't know the entirety of the market maker's book. Bingo. That's exactly right. What's happening in a market maker's book? A market maker is making markets not in SPX. They're making markets all over the place. What's happening here is you're seeing something that's built on a series of assumptions. The first assumption is that the market maker is on the counter side to every single trade. Fair assumption. It's not accurate, but it's close enough for a simplifying assumption. The bigger issue here is that we're saying, if I look at the market maker's book, there's SPX. So then as SPX goes this way or this way, the market maker is going to do something based on this data point alone. And it's completely fucking wrong, because they have this other thing that's not being included in here, which is where they've made markets in hundreds, if not thousands of other markets, definitely thousands and thousands of other options. So there absolutely can be scenarios where, let's say that it hits a spot where net gamma is long and people think that the market is going to behave a certain way. Well, that actually might be leaning into their position. So then their reaction to that could be quite literally the precise opposite of what people think is going to happen there, because of what the rest of their book might look like at that point in time, which we have absolutely no idea what it is. So this is neat. It's cool, but it is way too grotesque of a simplifying assumption for it to be even remotely useful. We have no insight into the rest of this, and a market maker doesn't adjust positions based on how one single option. They probably don't even know all the single options that they have. They look at the net Greeks of the entire book, and then they make decisions on net Greeks as they're taking on and releasing inventory. So I still track GEX. I still look at it. I've ran a bunch of studies on GEX. But yeah, the main thing to note is that it's nothing to weigh heavily at all. And again, I always encourage you, don't take my word for it. Check it out for yourself. The way that you have to check it out for yourself, though, is through an objective analysis. How do we do an objective analysis? We pick a point in time and we say, this is when I would use GEX. We write down what GEX was at that point, take a screenshot, whatever, and then we attach an assumption to it. Our assumption is when price gets to this point, it's either going to be amplified or reduced. And then you track that. You track what it does the day after, 5 days after, 10 days after, whatever window you're interested, or all three windows. And then you do that not once, not twice, not 5 times, but you try that as many times as you possibly can, trying to at least get to 50 instances, if not 200, much better. And then see what you see. The thing that you will see, because I've done this, is not much. You're going to see that it's not super correlated. It's just the same exact thing as support and resistance. Support is support until it becomes resistance. And price will straight up disrespect support and resistance as soon as there's enough of a catalyst. There's nothing wrong with using support and resistance, but we have to take it in the context of what it is. And again, it's just that. Support, while it's support, and then it's going to turn into resistance at some point. So super fun. Now, I want to give you guys your homework before I bounce. So the homework for the session today for episode 1, which is turning a market view into a trade, your specific homework is to pick a ticker that you want to pay attention to. When you identify that ticker, you should write down what your bias is, whatever it is, whatever you think it's going to do, whatever you think, however you think you're going to make money, which is the third thing, which is to outline what the specific profit mechanism is that you want to use in order to capture a potential in there. And then the fourth thing is to list at least 3 structures that you can use to trade it. And when you list those structures, I don't mean just write out, oh, I could be long a call. Be specific. Say I would buy to open the whatever expiration you choose, 50 delta call, and then I would do this or this, and then track it. That's the most important part. Track the outcome. So if you pick something that's a little bit longer term, then that's okay. But that's the fourth piece. So that's what I got for you guys. The next episode is going to dive into using the Greeks. So we kind of talked about the point to where you would actually click the button today and overviewed that section. The next session is going to be when we're actually getting ready to click the button to place a trade, the stuff that is important for us to look at and consider. All right, gang. If you guys need anything, let me know. Be an outlier. See y'all later.